Good morning, ladies and gentlemen. On behalf of the Czech National Bank, let me warmly welcome you at this quarterly meeting with analysts. It is my pleasure to introduce our three speakers for today. First is Vice Governor Vladimír Tomšík.
Good morning, everybody.
Second is Monetary Department Executive Director Tomáš Holub. And our third speaker is Monetary Department Deputy Director Petr Král. As you all know, yesterday the Czech National Bank raised its interest rates for the second time this year. The decision was based on a new forecast, which will be now presented to you by Petr Král. You have the floor.
Thank you for the floor again. Good morning again, ladies and gentlemen, dear colleagues. It is really my great pleasure to be here in this role again after some time. I have structured my presentation in the following way. First of all, I would like to heighten the assumptions on which our new forecast is based. After that, I will describe our new macroeconomic forecast in all possible detail. Later on, I will provide you with a brief comparison of the new forecast with the previous one. And finally, I will show you a sensitivity scenario that was prepared to address a particular issue or uncertainty or risk we faced when we were preparing our new forecast. As for the assumptions of the forecast on the external side, the October consensus forecast predicts that the GDP growth in the effective euro area will stay above 2% for the whole forecast horizon, and this growth will be particularly well pronounced in the rest of this year. That's why the economic situation of our major trading partner will be very positive for our economic activity. Growth of producer prices in the effective euro area will slow down to zero by the start of next year, which will be a consequence of the previous appreciation of the euro against the dollar, and also by the fact that the previous decline in world crude oil price will be affecting the producer price developments in the effective euro area. As you know, the ECB continues in its very accommodative monetary policy, which is reflected by the fact that the outlook for three-month Euribor is in negative territory until almost the end of 2019. The market outlook expects that the euro against the dollar will be steadily flat at slightly below 1.20 US dollar for euro. As for the domestic assumptions, as you know, after turning to positive figures in 2016, government balance is set to reach even bigger surplus this year, which is a consequence of ongoing robust economic growth and some fiscal discretionary measures taken by the government. And our forecast expects that the government balance surpluses will be at approximately 1.5% throughout the rest of our forecast horizon, which is both 2018 and 19. This will translate into the structural surplus being close to 1% on the whole forecast horizon, which means that the medium-term objective will be safely met. And the debt to GDP ratio will further decline to reach a tick below 30% in 2019, which will be a consequence of quite significant primary surpluses, still very low debt service costs, and quite buoyant nominal GDP growth. The real consumption, government consumption as a one specific demand component will grow by almost 2% this year, and roughly the same growth pace can be expected for the next 2 years. After being significantly restrictive in 2016, fiscal policy will turn to be expansionary this year and the next, and will be roughly neutral in 2019. This year's positive contribution of fiscal policy to GDP growth of 0.4 percentage point is related mainly to the renewal of public sector investment growth after the previous slump, which is closely connected to the EU funds cycle, respectively to the end of the previous program period and gradual start of the new one. Fiscal expansion will continue in 2018 in our estimates, but will be materializing more through the support of domestic consumption, of private consumption, which will be driven by a package of new social measures taken by the government recently, by faster growth of pensions, reflecting more generous pension indexation formula, and by continued buoyant growth in wages and salaries in the public sector. In 2019, as I already mentioned, the fiscal impulse will be roughly neutral. Let me now turn your attention to the summary of the new forecast. We expect that inflation will stay above our target within the upper part of the tolerance band, not only for the rest of this year, but for most of 2018, and will then turn from above to the target at the end of next year. GDP growth will reach 4.5% in 2017 and will slow down to slightly above 3% for both 2019 and 18 and 19. This will be a consequence of the fact that the economy will be supported by strong growth of private consumption, by the renewal of investment growth, and by the continuous growth in the economies of our major trading partners. Steadily growing demand for labor will face a progressively increasing shortage of available labor force, which will result in further acceleration of nominal wage growth. We expect that the exchange rate of the koruna against the euro will appreciate further, which will be reflecting the fact that the tightening of domestic monetary conditions is coming earlier compared to what we can expect from the euro area. And the continued real equilibrium exchange rate appreciation, or the real convergence process, will also act in the same direction. In addition to this exchange rate appreciation, the return of the inflation to the inflation target in late 2018 will be supported by further rise in nominal interest rates. As you know, we've observed some further increase in headline inflation in recent months, which was happening in the environment of accelerated GDP growth and nominal wage growth. This increase in inflation was driven by further pickup in the core segment of inflation, with food prices growing at a significant pace as well. Core inflation is currently driven by the non-tradable sector, which reflects the accelerated wage growth, especially in service sector and other non-tradable sectors, with one particular contribution stemming from higher dynamics of imputed rents. As I already mentioned, our forecast expects that headline inflation will stay above the target until almost the end of 2018, and will turn to the target from above in late 2018 or early 2019, where currently the monetary policy horizon lies. The monetary policy relevant inflation will be only marginally different from the headline inflation, as the expected indirect tax changes will be only negligible, and the profile of the monetary policy relevant inflation will be virtually the same as for the headline inflation. As for the structure of the price developments, we can expect that administered prices, after being roughly constant in the previous year, will start rising again next year, and we can expect that their annual pace of growth will be approximately 2% in both 2018 and 19. Fuel prices, domestic fuel prices, will moderately decline in the near term because of the previous decrease in crude oil price, with some contribution of the expected further appreciation of the domestic currency against the euro and subsequently against the US dollar, resulting to the fact that fuel prices will moderately decline over the whole forecasting horizon. Core inflation is currently peaking, and we can expect that it will slow down a bit as from the beginning of next year, due to the decline of import prices and due to the fading of some one-off effects that affected core inflation last year, which was predominantly the introduction of electronic sales registration in restaurants and other industries. We expect that the second and the third phase of this electronic sales registration will add on 0.2 percentage points to core inflation in 2018, namely in March and in June, where the next two phases are scheduled. Growth of food prices will temporarily accelerate further, and in the 2018 we can expect a marked slowdown of the dynamics, which will be a result of fading agricultural commodities prices growth and an effect of the appreciated koruna exchange rate. Total inflation pressures in the consumer sector are currently peaking, and we expect that those pressures will somewhat ease in the coming quarters, especially due to the fact that import prices will turn to be significantly negative in 2018, following the expected appreciation of the nominal exchange rate. Whereas the domestic fundamental pressures are also quite robust, they will increase further in the near term and will slow down only gradually throughout the rest of next year. This will be a consequence of the fact that the dynamics of total costs when producing intermediate goods in the domestic economy will gradually slow down, especially when expressed in the Q-on-Q terms. And this will be the case for both nominal wages and cost of capital. And in the same direction, the higher productivity gains will act. Thanks to the robust economic growth we have observed over the last couple of years, the previous economic slack has been fully eliminated and the Czech economy is currently operating above its potential. And we expect that this will be so even for the rest of the forecast horizon. Following the figures for the second quarter of this year, we can expect that GDP growth will reach 4.5% in 2017 as a whole, and one can expect somewhat a bit decelerating GDP growth for 2018 and 2019 being slightly above 3% in both years. The dynamics of the GDP will be driven by strong growth in domestic demand, especially in private consumption, by the renewal of investment growth, and by the continuous growth in foreign demand. As I mentioned, household consumption is growing very fast, and we expect that it will further accelerate by the end of this year, which will reflect the very strong labor market and from that stemming very rapidly growing disposable income. Investment growth will be also faster to the significant renewal of the investment activity in the public sector following the new EU programming period, whereas the private investment activity will be growing steadily as well. Both export and import dynamics will speed up further in the near term, reflecting the positive external demand outlook. And for the case of import, there is also a significant factor in the form of growing domestic demand, which is quite import intensive. The deceleration of both exports and imports on the longer horizon can be partly attributed to the appreciation of the koruna exchange rate. Continuously growing demand for labor is facing progressively increasing shortage of available workforce. That's why we expect that the number of employees expressed in full-time job equivalent will gradually decelerate this year, and this will be only partially compensated by the modest cyclical increase in number of hours worked per person. The supply of labor, the labor force, will be on the other hand supported by the gradual increase in statutory retirement age, which will increase participation rate in some cohorts, especially in some at some elderly people cohorts. As you know, after having decreased steadily over the last couple of years. The Czech unemployment rate got below 3%, which is currently the lowest figure among the EU countries, and therefore the potential for further decline is very limited. That's why our forecast expects that the unemployment rate will decrease only slowly and will reach 2.6% at the end of 2019. Growing tension on the labor market will lead to the further acceleration of nominal wage growth in business sector, which will be bolstered by the further increase in minimum wage approved by the government. The nominal wage growth will be peaking at almost 8% in early 2018, and it will gradually slow down to assumed long-term levels due to among other things, to tightening of monetary conditions. The long-term levels of nominal wage growth are estimated by the Czech National Bank to be roughly at 5%. Even more pronounced, even more hump-shaped profile can be expected when it comes to nominal wage growth in public sector, following quite generous increases in wages and salaries in public sector employees this year. We can expect that the dynamics will reach more than 11% at the beginning of 2018 and will quite sharply decelerate throughout the end of the next year and reaching approximately 5% at the end of forecasting horizon. Czech National Bank forecast expects that nominal exchange rate of the koruna against the euro will further appreciate. This continued appreciation trend will be driven by faster tightening of domestic monetary policy vis-à-vis the euro area and the continued real convergence process of the economy. Appreciation of the currency will mean some tightening in monetary conditions, which will be further supported by continued increase in nominal interest rates, which will, together with the expected appreciation, turn into the reversal in the inflation trend and to the return of inflation to inflation target on the forecasting, on the monetary policy horizon. Let me now provide you with a brief comparison of the new forecast with the previous one. To keep it sweet and simple, one can say that everything has been pushed up, at least in the near term. That's why I will go directly to individual trajectories. The forecast for inflation has been revised upwards for the near-term part of the outlook, which is implied by stronger inflation pressures from the domestic economy and especially from surprisingly robust nominal wage growth. GDP forecast was revised upwards as well, but only for the for a couple of next quarters, which is also reflecting the fact that the GDP for the second quarter of this year surprised us on the upside, and this surprise was in both consumption and investment activity. Unlike this change in the forecast, in the near term, the outlook for the longer horizon remains virtually unchanged, as the basic fundamental parameters of the demand growth hasn't changed much since the previous forecast, which is the demand outlook for the euro area and the fiscal impulse, which is broadly the same as we had in our previous forecast. So that's why the GDP dynamics returns back to approximately 3% in 2018 and 2019, which is consistent with our steady-state estimate of steady-state assumption on potential output growth. As I mentioned, the nominal wage growth surprised us on the upside for the second quarter of this year, which together with better than expected economic activities pushing our nominal wage forecast upwards as well, and the deviation from the previous forecast is especially pronounced in the next couple of quarters. And with the trajectory of the interest rates consistent with the forecast has been shifted upwards compared to the previous one, which is reflecting the greater accumulation of inflation pressures from the domestic economy to which monetary policy has to react. When we were preparing our new forecast, we identified a particular uncertainty or risk concerning the strength, the composition, and the persistence of domestic inflation pressures. And that's why we have come up with a sensitivity scenario addressing this risk and illustrating its impact on monetary conditions, illustrating its monetary policy implications. The sensitivity scenario of higher domestic inflation pressures supposes that wage pressures or domestic inflation pressures will be longer lasting compared to the baseline, as nominal wage growth will be even more pronounced, and that the productivity gains will be a bit slower compared to the baseline. So higher wage pressures in this scenario are pushing inflation up compared to the baseline, to which the domestic monetary authority has to react to prevent inflation from divergence from the target for a significant period of time. That's why the 3-month PRIBOR trajectory is going up more rapidly compared to the baseline, which is pushing the GDP growth to a bit slower pace compared to the baseline, and that's why the CPI inflation is above the baseline scenario only to only limited extent, and both interest rate component and exchange rate component of total monetary conditions are working in a stabilizing way. Having said that, I would like to thank you for your attention for now, and I am passing the floor back to the chair.
Thank you, Mr. Král, for your presentation. Before we proceed to the Q&A part, let me give the floor to Tomáš Holub, who would like to say a few words.
Thank you very much. Good morning also from my side. Before we start with the discussion, I would just like to say that this forecast that you have just seen was the last forecast prepared by the macroeconomic forecasting division headed by Tibor Hlédik. Tibor was head of the division for 13 years, so I think it's worth mentioning, and I believe that his work was very much appreciated, not just in the Czech Republic, but also internationally. And indeed, he decided to go for an international career. He has moved to Joint Vienna Institute. So he's not that far away, but he will now focus on providing training and technical assistance to many countries of the region. So I wish him good luck. Currently the division is headed by the deputy head Radek Schnobel, but we expect that the appointment of the new head will take place by the end of this month, so you will of course be informed. So thank you.
Thank you, Tomáš. And now I would like to hand over to the Vice Governor, who will take and distribute the questions from you.
Thank you. And also let me say good morning, everybody, and thank you for coming for this discussion. And before we open the discussions, I just also want to say what Tomáš just mentioned, that the bank board also thanked to Tibor Hladík for already his significant contribution. And I'm saying that because if you look at our latest forecast, if you look at how we presented and how we really conduct the monetary policy, you see that people are leaving and new people are coming. And you see that we still have the same monetary policy. We still have, model-based forecast. And this is something what is really robust for this institution. So you see that the monetary policy doesn't depend on 1 or 2 persons. No, we are a very robust institution regarding pursuing monetary policy. And finally, I'm also happy that we do have something to export regarding the knowledge of monetary policy. So it's very nice that we can disseminate, our experience, our knowledge regarding, hiking interest rates, regarding introducing FX commitments, etc. So we will see for the future. Anyway, I will be happy to take, as usually, 2 or 3 questions in the first round, try to combine them and answer them just to save some time. And if those questions are more in technical way, I'm very pleased that Tomáš or Peter, they will help me regarding the technical details. If you have questions regarding the monetary policy discussions during the bank board meeting, yesterday's bank board meeting, I will be happy to share what we discussed yesterday. Who is going to be the first one? And always please introduce yourself, because most of you, I know that, we know that, but you know that this discussion is transmitted via, internet, is it? Yeah, it's transmitted, so definitely you should introduce yourself. So, please.
Jakub Seidler, ING Bank. Given the recent comments from some CNB representative, including Chief Economist Tomáš Holub, that interest rate path might be more linear compared with the previous August forecast, and also recent comments from board members that there is much more room for hiking cycle, market might be a little bit confused from the recent trajectory of interest rate, as the path of the rates for 2018 is relatively flat. So I wanted to ask how to understand whether the board see the room for the interest rate hiking cycle a little bit higher compared with expert or staff forecasts, or something has changed recently, for example, normalization in forward points, etc. Thank you.
Thank you for a question. I think it's clear. So do we have the second questions for the first round? So the question was about yeah.
Jaromír Šindel, Citibank. You increase also not only the 2-week repo, but also the Lombard rate. I would like to ask you about the discount rate. How do you see the future corridor between the main policy rates in future?
Thank you. So both questions can be definitely put together. They are about interest rates. And do we have the third one, the final one? If not, so okay, let me handle with those questions. First of all, I think it's fair enough to say that once we do have a bank board meeting, we always discuss a lot of things. And regarding, there was a discussions whether we should also hike by 50 basis points, for example, yeah. But on the other hand, and we published the interest rate path yesterday, and it was presented by Peter just a few minutes ago. If you look at it, it seems to, and compare, the current PRIBOR, what we really see in the market right now, and Tomáš, he has just checked the morning, PRIBOR, 3 months PRIBOR, it seems to me, and you can compare it by yourself, it's very, very close to each other. Just compare the, assumptions of interest rate, assumption, and current 3 months PRIBOR. And if you look at it, you have to say to yourself, well, they are very close to each other. Is there really significant, need to increase, basic, repo rate higher? If everything is lined, there is no need. I understand there were some, comments of some of the members, including chief economists, who will probably respond that. But on the other hand, you have to distinguish, what is, comment by one member, another member, and what is the majority, yeah? And again, you have to compare, the current economic environment. Plus, and of course, we decide at that time, and yesterday when there was a decision was taken yesterday, well, some new information arrived, in the latest days. One of the newest one was, of course, ECB decision. And Peter, he commented it at that. Well, yesterday we got information, that was, 1 week ago, that, ECB would continue in quantitative easing at least until, September next year. And we don't live in a vacuum. Of course, we are a small open economy. We see there is a significant, inflation pressures coming from domestic economy. But on the other hand, we have to look what's going on in the external environment. And of course, quantitative easing is one piece of information. Another one, if you look at PPI in Eurozone, and there is a clear forecast, and you know that we just take this consensus forecast, there should be some significant, decline. So back to your questions, there is always a discussions whether we should, increase or, I don't want to say decrease, but there is a several, discussion about that. And there was only one proposal to increase by 25 basis points, and it was unanimously, decided. There was no any other proposal to vote. There was a discussion, but not any other proposal to vote, yeah? And again, we look at the current economic environment, there was probably no need to even discuss it. Even to make a proposal. Back to the Yara's questions, it was very nicely described by Governor during his, press conference yesterday. He called it as a normalization. I just say nicely because it has some specific connotation in the Czech language, yeah? But back to the, probably the monetary policy we used to have before the financial crisis. And you know that there was spread between repo rate, Lombard rate, and deposit rate. And personally, I don't see any obstacles. I don't see any, different idea why we shouldn't, follow what there was there before the financial crisis. Yeah. So back to the normalization, if I can say that. Tomáš, if you want to provide some comments regarding the comments provided by chief economist.
Mm-hmm. Maybe a comment on the question by Jakub Seidler. If you compare the current forecast with the previous one, the interest rate path is definitely smoother in terms of the hiking cycle than the previous one. It's of course not ideally linear, but it's still true that we also have the effect of quantitative easing in the forecast, which provides a kind of break on the pace of interest rate increases in the forecast for the next 2 or 3 quarters. The forecast itself has unchanged assumptions about the QE by the ECB. Its decision in October was announced after the forecast was finalized. We did a quick update related to this new piece of information, but it seems that it goes in the expected direction, like even a somewhat more gradual rate increases, but to a very minor extent. So it's not such a big new information. But back to this, the impact of the quantitative easing of the ECB plus the ongoing negative policy rates in the euro area versus the rate hikes in the Czech Republic mean policy divergence between Czech monetary policy and euro area. And because of that, we have a relatively front-loaded exchange rate appreciation in the forecast. And as a result, we have a somewhat backloaded hiking cycle of the interest rates, so that the overall normalization or neutralization of monetary conditions is relatively linear. Of course, if in practice we see a more linear exchange rate path relative to the forecast, then also the interest rate path could become even more linear compared to what we have now published. And on top of that, you can also see the sensitivity scenario. The sensitivity scenario also implies that if the domestic inflation pressures turn out to be stronger and more persistent, then the forecast currently assumes the rate hiking cycle could be like more linear than the baseline scenario.
Just to end it up, I mean, this question, and I think that you're an analyst, so you know that you know, what we can say, we can, I think, clearly describe the current economic situation. You know that we provide, I mean, forecast for next 12, 18 months, but on the other hand, it's just a forecast. And we publish, I mean, the interest rate pad, it's something as assumptions. I'm just saying, I understand there is assumptions of, I mean, having flat interest rates probably in the mid of 18, next year, yeah. But if we see there is a change in the economic environment, you know, we will decide. So right now, it's what we predict based on the current economic environment. But again, I'm going to beg to mention what was said by Governor yesterday. We do have 8 monetary policy meetings a year. And I'm going to say at least 8 monetary policy meetings, because for this year, you know, it will be 9. We had one more, it was in April 6th, you remember that? Yeah, there was an extraordinary monetary policy meeting. So, and I mean, once we see there is a change in economic environment, we can act immediately, okay? So let me open the second round of the questions. Helenka first.
Thank you. Helena Horská from Raiffeisen. In your prognosis, we can see that you are count with corona appreciation. And as was mentioned yesterday, you are ready to publish the currency forecast in February. Thank you for that. But question is, what if the currency would not appreciate as you are forecasting? You are ready in your thinking box to start hiking more aggressively?
So we do have first questions. The second was you were the second one.
Viktor Zeisler, Komerční banka. Thank you for your presentation. I might have more complex question about the FX rate and how is it actually tackled in the model. You say that you have a front-loaded, well, let's say, tightening of monetary conditions through the FX and back-loaded with the rates. Given how you actually work with the FX rate and the FX rate assumptions, this will probably be the case for the future forecast as well, as well, you don't count with the position. Well, there are shadow rates with Euribor and counting with Pribor, which maybe also would be for another discussion. But if the corona does not appreciate, then it will again appreciate in your forecast. And you are looking forward. You are looking a year forward, and the corona will appreciate in your model again. So it will again make the front-loading and back-loading of the FX rate and rates respectively. So actually, the forecast will never show you a rate hike because there will always be appreciation, and because you really do not look at the current FX rate, but you look at the forecasted FX rate. So could you elaborate on that, if this is true, and how would you actually be evaluating the forecast of rates and FX and actually the monetary conditions change and this interaction? Thank you.
It seems to me that both questions are very similar. I will try to handle them, but Tomáš will continue in more technical details. We have one more question in this round, please.
Martin Paul, General Investments. I would like to continue with the topic of exchange rate. Maybe one more empirical question. We have observed some data on inflation, import prices. What about the exchange rate pass-through? Does it or has it corresponded so far to your expectations and assumptions, or do you see some significant deviations also in comparison to the experience we had with the big depreciation of Czech koruna?
Thank you. So let me close this round, and it seems to me that all three questions are very similar. They are, dealing with exchange rate, interest rates, and what kind of, equation, what kind of economic idea is behind our model, or how we really modeling the exchange rate path. Well, first of all, let me start with the last questions, because the question is very clear, and the answer is going to be also very clear. You are asking me whether the current exchange rate is very close to our, I don't want to say forecast, but to our assumptions. You know that I can't say exactly what kind of level exchange rate we predict for this quarter, next quarter, etc. But on the other hand, and I just answering the first round of the questions, we hiked interest rates by 25 basis points yesterday. And I said that, if I compare, 2 days, 3 months PRIBOR, and you can compare it with the interest rate, what has been, included in the forecast, they are very similar. It clearly shows, once we do have very similar, current interest rate environment, which is forecasted, in our forecast, the same must hold for exchange rate. If not, probably there would be a discussions regarding probably higher interest rate hike, yeah? So my answer, I can't say the figures exactly, but it's very currently, exchange rate, situation is very, very close to what we see in the market. Otherwise, we have to deliver, something more in interest rates. It's logical. Several times we have been talking about that, that once we pursue monetary policy, we have to rely on both legs, exchange rate as well as interest rates. Unfortunately, they are not, working with the same channels. We do have exchange rate channel, we do have interest rate channel. Both channels, they do have some time lags. Both channels, they do affect some different probably sectors, etc. But right now, we delivered regarding interest rate what we expected in our forecast. So based on these assumptions, we are not surprised with the current exchange rate. Regarding the future, how we calculate it, what we expect, I think that all those basic equations. The most important one regarding our model-based forecast is uncovered interest rate parity, and Thomas, he will be dealing with it in more details. But what I want to say, and your question was about, the future appreciation, and if I understood correctly, you said that, the Czech economy, the Czech currency, would be faced with appreciation, for a longer horizon. But on the other hand, and we are very transparent, we have already published it, that based on our real convergence process, by the way, with this issue we will be dealing in more details with our alignment analysis of the Czech economy with the Eurozone, which is going to be published in a few weeks, in December, I guess. We just sent it to the government, and it has to be approved by the government in a few weeks. And we have already said that we calculate with real convergence process, which will have an impact on appreciation of the Czech currency, like 1.5% year-on-year. So I would be surprised if there were, higher appreciation in the long run, because it must be based on convergence process. If there is some pressures coming from some investors, from some speculatives, I would say inflows, etc., well, it can be in a short run. But in the medium run, in the longer run, it will affect the competitiveness of this economy. And it's a question of time when there will be some adjustment of the exchange rate. So it doesn't seem to me that we have to be surprised by, strong appreciation for a longer period. I wouldn't trust it, And yeah, the final remarks regarding the exchange rate path. And we are transparent institutions, and we just had to switch to some other unconventional monetary policy tools. It was in November 2013. At that time, we clearly said, let's suspend publishing exchange rate path. But once we are back to and it was said by Tomáš, neutralization or normalization of monetary policy, we will resume publishing this exchange rate path. And I think, you know, now we are talking about normalization, I mean, neutralization, let's do that. Of course, and there was a discussion yesterday, that's why I'm here and I represent what was discussed yesterday. There was a discussion, let's publish it immediately, yesterday. But honestly, we want to demonstrate that we don't want to just declare, look, we are going to publish because we think it's perfect for us forecast. It's perfect right now. And I clearly said, I mean, current exchange rate environment, exchange rate, I mean, development is very close to our forecast. But we want to clearly demonstrate to the market that it's just an assumption. It's not a commitment. So, and you know, yesterday we decided, and we published only one sentence. It's a very strong sentence. The sentence says, well, CNB will resume publishing exchange rate paths starting from next year. And honestly, now it's November 2nd, 3rd. We do have like 2 months left to the end of this year, November, December. Nobody knows what will happen with the exchange rate in these 2 months. But there is something as a statement, commitment, start publishing, I mean, this exchange rate path. Why? Why? Because we want to demonstrate it's always only something as an assumption. It's not a commitment. So once we publish it, it will be at the beginning of February, Tomáš, yeah? 3 months. And the exchange rate in February is a little bit different comparing what we will expect in the forecast. We will publish it, but we are going to say, look, it's not a commitment, it's an assumption. We have to deliver something different with the interest rates. Again, both legs of monetary policy. And it's a perfect way to be transparent. It's a perfect way to demonstrate your analysis to the public. Yeah, I know that you know that, but the general public should understand it. Well, why are they publishing right now? It's completely different. I mean, with the current economic, current exchange rate, we say, because we are not afraid of that. It's just an assumption. It's not a commitment. And if the assumption is not met with, you know, with the forecast, I mean, the current environment, we have to do something different with the interest rates. Yeah? Tomáš, please, could you elaborate on that?
Maybe I'll add one comment on Victor's question and one on Mr. Paul's question. As regards the exchange rate path, we actually do take into account the positions in the market for the fourth quarter of this year. So as Mr. Tomšík mentioned, the current exchange rate is close to what we assume. We also take it to some extent into account for the first quarter of next year. So it's not that we ignore it, we take it into account, but we are not sure how long it will really significantly affect the exchange rate dynamics, and we want to be on the cautious side. The same for the shadow rate, which reflects the QE by the ECB. Of course, it's not a perfect concept, but it's a way how to incorporate the impact of what the ECB is doing on the exchange rate of Czech koruna against euro. We chose in the past a rather conservative estimate of the shadow rate. There were shadow rate estimates like -7%, -8%. Out of those, we actually chose, I would say, the most conservative estimates, and at the same time, the way it's incorporated in the forecast reduces the impact. It's definitely not a one-to-one impact. Traditionally, when the market interest rates abroad change and the outlook changes, it has almost one-to-one effect on the prior outlook in our forecast. It's a bit less than one-to-one. It's say 1 to 0.8. This is a kind of rule of thumb. But it's much less for the shadow rate. That's why I said that the extension of the QE by the ECB by 9 months at reduced quantities it has some impact in the quick update of the forecast in the direction of slower interest rate hikes, but quantitatively the impact is really very small. And as regards your opinion that we will be just like pushing the wave in front of us, to some extent you may be right, but not completely. I think as we will be approaching really the period of time when the ECB starts moving to less expansionary monetary policy, this kind of problem will become less and less relevant. And basically from now on they have announced they have 3 more quarters to go, and then we will see what they will do. So I think as I say, the interest rate path in the forecast will probably not become ideally linear, but maybe like move in that direction from one forecast to the other. If the exchange rate does not appreciate significantly, if it appreciates less than what the forecast assumes, of course, due to the positioning. As regards the exchange rate pass-through, I would say that so far it has been in line with our expectations and our models. If you look at slide 13 in our presentation, which shows the analytical decomposition of the fundamentals that are driving inflation, you will see that our assessment is such that import prices have already started to have some anti-inflationary impact, but so far it is relatively small, and we expect the impact to be the strongest in the first half of next year because of the gradual pass-through to prices. And also if you look at the data with bold eyes, you would see some impact on some tradable commodities. Within the CPI basket, you can see an impact on industrial producer prices or some import prices, especially the import prices of goods with higher value added. But overall, it's still relatively small to see a big impact on the overall CPI. It's now dominated by other factors, such as relatively fast growth in food prices and acceleration in non-tradable prices within the core inflation. But looking at the forecast, we actually expect that both core inflation and food price growth will turn down, and one of the factors will be the appreciation of the currency. But the impact will become more visible over time, we believe.
Thank you so much. And I see it's exactly 12 o'clock, so let's start the third round, and we will see whether it's the last one or not, but definitely I can promise you we will continue in some informal discussions, because it's the last meeting for this year. So we will have some, I don't want to say Christmas lunch for you, but definitely there will be some possibility to have some informal discussions. But anyway, let's open the third one, and I saw Mr. Sobíšek.
Pavel Sobíšek, UniCredit Bank. Let me ask additional question on the interest rate path. What was discussed so far was the short-term horizon, but I would like to elaborate on the longer-term horizon, the end of your forecasting period, where it is seen that the 3-month PRIBOR should rise quite substantially. And my question is why, if the economy will be on the slower path, and meaning that also no major pressures in inflations are seen, and so whether the reason is that you assume rather steep rise in Euribor rates, or whether it's a nature of the model that that the path of PRIBOR has to converge to some neutral level? Thank you.
Okay, so that was the first question. Yeah, lady over there.
Hello, Maiduan from Bank of America Merrill Lynch. I apologize, I was a bit late, so I'm not sure whether these questions were asked at the first round. But I would like to ask you about your monetary policy transmission. Obviously, the rate hike is intended to give some signaling to the economy, and how that will affect the mortgage rate is also part of the sequence here. So far, in terms of the impact on the yield curve, are you happy with the transmission mechanism there? And on the side, with the exchange rate, Mr. Holub used to guide us a little bit on the path between different inflation report. Can you elaborate a bit to say that compared to the previous one in the one-year horizon, are you seeing stronger or weaker Czech crown versus the August assumption? Thank you.
Thank you. So we do have like 2 questions. And yeah, please go ahead.
Thanks for having us. Kubilay Öztürk from Deutsche Bank. A follow-up question on the transmission mechanism, because today you mentioned twice the fact that 2-week repo rate is very close to 3-month PRIBOR rate, and historically they haven't been like that. So do you think, is there a change in the transmission mechanism happening, especially in the money market rates, and is it changing your monetary policy stance via not hiking as much as the markets are pricing in? And secondly, the initial question regarding the upper end of the corridor ceiling. You already mentioned like it's a normalization, but I think it could be also from the markets as perceived as possibility of 3-month PRIBOR going higher than the 2-week repo rate, because now the corridor ceiling is higher. So whether are you going to be concerned about that kind of changes? And one fundamental question maybe to the technical colleagues, because you mentioned the shock as the wage costs. So what's the pass-through that you expect from nominal wages to first core inflation and to headline inflation? And the final question is, in the new CPI forecast, you have literally more than a year of inflation above the target. Of course, it is within the target range, but it is above the target for 2 years, which means that any kind of shock is going to put you higher than the 3%. I mean, you mentioned that you have more than meetings scheduled. You can do whatever, what the conditions require at that point in time. But don't you think that that will create some kind of market pricing for nominal money market rates to go higher from here? That will be the questions.
Thank you. Thank you for several questions. There was not only one in the theater, there was several questions. And I'm going to surprise you. I will start with the last one, seriously. You know, I understand that we are in the, above inflation target right now, because current inflation is 2.7. Tomáš, is it exactly 2.7? Yeah. And the same holds for the forecast. Yeah. But still, it's a tolerance band. So we are in the tolerance band. And honestly, you are an analyst. You know how it's difficult to really, create a forecast and successful forecast. And if you put all macroeconomic, macroeconomic situation, macro environment, all payments, it's always very difficult to say that all, increase in prices must be exactly by 2%. It's not easy. But and I'm happy that Peter Král, he presented our sensitive scenario, so we have also asked ourselves, well, what to do if there is more persistent inflation pressures coming from domestic economy? If they are stronger, yeah? And the answer is very easy. We do have no limits regarding interest rates. No limit. We can sit and really act immediately, yeah? And we will see what will happen with the exchange rate. Well, it can help us. The previous round clearly said there was some afraid of that the exchange rate can help us. So I'm just going to say, we are stick with 2% inflation target. It's clear. We do have a tolerance band. And I think that nobody is talking about, really high inflation, double-digit stuff. No way. We do have tools to really cap inflation and to act immediately. And in your question, you clearly said shocks. If there is a shock, I can't rule it out, but some of the shocks can be taken as exceptions, you know? What is really very important, and really, please, let me come back to November 2012. All of you remember that at that time, there was a really, significant threat of deflation. We didn't have enough appropriate tools to really act it. And there was a significant, critic regarding once we embarked on FX commitment in November 2013. I think a lot of you just read the previous articles you wrote 4 years ago. Well, you see that it's always better to see some really persistent inflation, pressures coming from domestic economy, because we do have some impact, we do have tools regarding domestic economy. And we have to be on the safe side regarding some shocks coming from external economics. And it was clearly said, I don't see a really significant shocks regarding inflation coming from external environment. We have just mentioned ECB policy. We have just mentioned PPI in Eurozone. So once we are talking about current inflation 2.7, once we are talking about current forecast in the upper tolerance bound, I think this is something what this economy, you analysts and the whole general public wanted to see in 2012. Again, let's read the articles that was written in 2012, 2013 regarding FX commitment. Another your question was about wages. Yeah, well, I'm also very happy that we are quite fine regarding inflation. We can call it as a price stability in the tolerance band. And you see, we do have the best unemployment rate in the whole European Union. Of course, it creates some pressures regarding the general bill wage, general nominal wages. But on the other hand, and I'm very happy I wrote it down, you have to also look at the productivity. Productivity in last year, what was the productivity in last year? It was less than 2%, 1.3. What is the forecast for this year? Is it around 4%, something like that? For next year, around 3%. You see, don't talk about wages. We should also talk about productivity. You should also talk about unit labor cost. Right now, it's like 1 point something. Tomasz, what is it? It's very low, unit labor cost. You see, so all those figures were clearly discussed yesterday. We do have a big table. It was even published, this table, you know. So don't focus only on one figure, which is wages. You have to talk about the whole macroeconomic environment, yeah? Well, regarding the difference between repo rate and 3 months PRIBOR, maybe it was my mistake, but definitely I haven't said, I have in mind, the spreads between 2-week and 3 PRIBOR. No, it's still the same. It's like 20 basis points, I think, you know. It's very stable. Even it was very stable during the financial crisis. I was talking about current 3 months PRIBOR. In the morning, it was like 0.61. And what we forecasted, or what we expected in our forecast. So those figures are very close. Exchange rate in our forecast and current 3 months PRIBOR, they are very close. Of course, there is a difference between 2-week repo rate and 3 months PRIBOR because it depends on the risk. It's a like 20 basis points is a spread. And we still calculate the same spread. We don't see there should be any change in risks, yeah? And now it allows me to come back to the first questions provided by Mr. Sobíšek regarding the level of interest rates, I would say, at the end of the forecast or at the end of the fund chart what we published. First of all, you know that our forecast has been always aiming for next 12, 18 months. And this figure, which is, page number 20, you know, says something about the second half of 2019. And you know, this is not a forecast. The end of the, figure, it's about, I would say, long equilibrium. So, and Mr. Sobíšek asked me about that. So I'm just saying that, you know, we still calculate interest rates, long-run interest rates in our forecast, in the long run, 2, 3, 5 years, you know, around 1%. We haven't changed our assumptions. So it seems to me it's very difficult to say exactly in November this year what will happen in November 2019, next 2 years. But we still try to, using general equilibrium model, general stochastic equilibrium model, and even dynamic model, we are trying to say that we are stick with nominal increase like 2% based on our inflation target, and we still expect that the real yields, real interest rate should be like 1%. Put together, it's logical. There should be like around 3% nominal interest rates. So this is my answer. It's mostly based on a really, I would say, sustainable economic development in the long run. It's not about putting current economic conditions together using endogeneity and general equilibrium models and to calculate what will happen in the next 12 months. You know, this is a little bit different. I mean, the short-run forecast and forecast for the next 12, 18 months and comparing with the long-run sustainable economic development. And Tomáš will definitely help you a little bit more. And the last questions about the transmission and yield curves. Yeah, it seems to me that, you know, and you also mentioned, I mean, the transmission to real economy, and if I understood correctly regarding, I mean, mortgages, well, I think so far the transmission works. We see that once there is an interest rate hike, and we definitely saw it in August this year, and we delivered the second hike yesterday, so far we have seen there is an impact on market interest rates. If you want to address the issues regarding, I mean, mortgage, etc., well, it's absolutely about different story. It's about financial stability, and if we see there is something wrong, we will, and we have been already using macroprudential tools. Yeah, it's not about only the price for mortgages, it's also about using some other tools. Tomáš, I think I have answered almost all answers. At least I touched all of the questions regarding from the bank board policy view, but I'm going to ask you for more technical details to explain it.
Okay, thank you. Maybe I'll comment briefly on the long end of the interest rate path and on the wage transmission, and then I will ask Petr to add some comments on the exchange on the interest rate transmission and the spread between the 3 months PRIBOR and 2-week repo. As regards the long end of our interest rate path, we talk now quite a lot about the fact that we are in the process of normalizing monetary policy. And I think it's good to have a view what's the end point of normalization, what normality means. And we still assume that a kind of policy neutral rate for the Czech economy is 3% for 3 months PRIBOR in nominal terms. And for an economy which is actually operating somewhat above its potential, current inflation is somewhat above the 2% target. It's expected to go back to the 2% target at the relevant policy horizon, but not to undershoot anymore or to any significant degree. It is quite logical that sooner or later you should be back to the policy neutral rate. Of course, it's a question of how quickly you can go there, and the pace of this normalization has to take into account the external environment, including the still very easy monetary policy by the ECB, and that's why a lot of that normalization is in the forecast, like concentrated into 2019, which is a year in which we assume that QE will already be over and market rates in euro area will go away from the negative territory to slightly positive. And it's fair to admit that the model assumes a somewhat faster normalization of rates in the euro area compared to the current market outlook. It's not like a fast normalization that we would assume, but it is a little bit steeper, especially for the second half of 2019, which contributes to some extent to the pace of interest rate increases in our own forecast for Czech rates. As regards the question about the wage transmission, it's definitely one of the key fundamentals for price developments that we assume, it usually has the most visible impact on core inflation. And within core inflation, of course, it's even more visible on non-tradable prices, because in the non-tradable sector, the fast wage increases cannot be matched by productivity growth. So actually, now we are in a situation in which the unit labor costs grow already relatively swiftly compared to the past, but it's even more visible in the non-tradable sector. And if you look at slide 9 of the presentation, which shows the decomposition of core inflation into the tradable prices and non-tradables, you can see that the non-tradables are growing at around 4%, which is much more than only a year ago. So the acceleration was very fast. Of course, it was also affected by some one-offs, such as the introduction of electronic registration of sales in restaurants. It's also affected by the changed calculation of imputed rents. So it now also reflects growing prices of new residential real estate. But the key fundamental is really the wage growth. So it is very important, and because of this, we actually expect that there will be some further acceleration of core inflation, not to a large extent, but in the rest of this year, and we'll stay at relatively high levels of core inflation also in the first half of 2018. But then it will be pushed down a little bit, closer to 2%, because the one-offs will drop out, and also the exchange rate appreciation will have a more visible impact on the prices of tradable components. And maybe Petr could add something on the transmission questions.
As you can derive from the table of key macroeconomic variables, which was published today together with the summary of the inflation report, the forecast assumes that the spread between 3-month PRIBOR and 2-week repo rate will be at 0.2 percentage point over the whole forecast horizon, which is a level which was very close to what we saw before the crisis. You have to take into account that this spread always has in it some expectation component following the communication of the board members in between monetary policy meetings and your and market reaction on that. But basically, we can expect that this part of transmission will work in a normal way as we were used to it before the crisis. Following the first hike in interest rates in August, and especially September outcome of the monetary policy meeting, market interest rates, I mean the whole yield curve, started to be moving up, and we saw that the market started to expect rising interest rates derived from the FRA instruments. The IRS and Czech government bond yields also moved up very significantly, and this trend has been further supported by the communication of several board members between September and November board meeting, and I suppose that nothing dramatical has changed in this front following yesterday's outcome, as it was broadly expected by you or by the markets that the CNB will hike interest rates by further 0.25 percentage points. As for the transmission to the client interest rates, we only have data at our disposal for September, which is 1 month after the first hike done in August. That's why we can only see only limited kind of transmission to client interest rates. And you also have to take into account that, especially for mortgage rates, macroprudential policy measures taken by the CNB, those LTV limits, are also influencing the interest rates developments in this particular mortgage sector. Thank you.
Okay, so Peter and Tomáš, thank you very much for your very significant contribution in the discussion. And I look at my watch and I see we do have like 20 minutes past 12, and I think it makes sense to save some time for really informal discussions and for lunch. And it's the last meeting with you for this year. And it's a tradition of these institutions that we also want to have some informal meeting with you, and to provide you some benefits for those who has, really spent time and has arrived to our institutions and participate in these discussions. So the analysts who are just, watching us through the internet, they will not participate in the lunch, but you are invited for I can call it as a light buffet lunch and to have some informal discussions. And I remember, well, it used to be something as a Christmas meeting, but it's really too early to say, Merry Christmas, but let me thank you for following Czech National Bank, for participating in discussions, and let me wish you really, successful days at the end of this year. And now I turn over to Markéta. She's going to continue.
It seems that everything has been said, so let me conclude by thanking you all for coming. And as Mr. Tomšík already said, let us invite you to a traditional buffet lunch downstairs. Please don't forget to take all your stuff downstairs with you and join us for a chat and good food. I'm looking forward to welcoming you back here on, I guess, February 2nd. Thank you again and goodbye.
Thank you.